Hi, and welcome to our LinkedIn Live series on the release of the ISM Report on Business. My name is Dan Zeiger. I'm a senior writer and copy editor for Inside Supply Management, which is Institute for Supply Management's member publication. And we're happy to have you with us as we discuss a lot of movement, again, in the Services PMI data. The composite index reading was 48.8%, and that's in contraction territory for the second time in 3 months. And when you get a combined month-over-month decrease of 18.4 percentage points in the important business activities and new orders indexes, you're likely going to get a big hit on the PMI. And that's what happened in June. It was down 5 points compared to May. So there's a lot to talk about. Let's bring in our new chair of the ISM Services Business Survey Committee. His name is Steve Miller. And listen to your conference call with reporters earlier in the day. I appreciated your candor during that. So I know we're going to have a lot of interesting things to talk about. But let's just break down the data. I mean, I've said for a long time that, one of the great uses of the report on business is that if there's an unexpected increase or decrease in the PMI, you just quickly look at the sub-index data and you can quickly tell why that happened. And obviously this month it was a story of demand, business activity, new orders, new export orders, which does not directly factor into the PMI, but it did take a big hit. They all decreased significantly. Just what happened from your standpoint, Steve?
Yeah, good morning, good afternoon. Thanks for having me on, Dan. It looks like a pretty consistent lower rating. You see you mentioned two of the three components, but we saw three, the new orders index, the business activity index, and employment index, all in contraction territory. The supplier deliveries, we saw it, the slowness getting a little bit weaker in dropping from a 52.7 to a 52.2%. For me, the bigger story, or the big story there, was just seeing the number of industries that went from growth to contraction month to month. So for me, I mean, there were 8 industries that were in contraction territory versus 5 last month, and there were 8 in positive territory, which was a reduction of 5 from last month. And the difference in the ones that slightly improved to the ones that got worse was a difference of about 35% of GDP. So about a 4% of GDP saw an improvement month over month, and about a 40% saw a decrease. So that for me was kind of the big aha in the overall reading. But other than that, I think you covered it very well.
Yeah. I was listening on the earlier call, and you kind of broke down, some of the industries that really underperformed in June as compared to May. Real estate, rental, and leasing is one of those. And sorry, I couldn't help out. I did not buy a mansion in June, but just thought, that's something that your predecessor, Tony Nieves, has talked about a lot, the importance of real estate, rental, and leasing. It's the largest one for GDP. And, when that industry has a bad month, chances are it's going to be felt across the services sector.
Yes. And I saw transportation and warehousing and wholesale trade in the shift as well.
Mm-hmm. Yeah. Business activity, that was an interesting one. It's been really volatile in recent months. 2 months ago, it had a nice medium-sized spike. I believe it was 6.9%, if memory serves. And then in May, it went. Anyway, it's been up and down. It looks like an EKG. I'll have to look at my chart here to get the exact numbers, but the most recent one, it took a pretty big plunge, 11.9 points. Just talk about the recent volatility there and just the impact that it's had on the overall picture.
Yeah. So for business activity, we saw a pretty broad decline. Education, public administration, real estate, as you mentioned. Transportation and wholesale trade. So pretty broad reduction, in in terms of seeing lower levels of business activity from last month. And then remember last month it was pretty high. This is relatively flat to 2 months ago. So just trying to get a sense for what's really driving it on the new order side. This is the first time at this level since December of 22, and where we saw the biggest drops again were real estate, rental and leasing, and wholesale trade, and then there was also agriculture got into the mix there.
Yeah, I'm going to give you the correct data. Just business activity index was down 6.5 percentage points in April. It went up 10.3 points in May and was down 11.6 points in June. Just to get the correct data out there. One of the in the comment or in the report itself, which is available at ISM's website, ismreport.org, you had a comment in there, ismworld.org. I'm sorry. Had a comment in there about supplier delivery performance being impacted more by supply chain and transportation issues. Not so much that, or more than that, impacted more by supply chain transportation issues than demand. Could you just elaborate on that a little bit as I try to get a handle on my tongue here?
Yeah, so that was me trying to connect the dots on different sides of it. If we saw a broad reduction in business activity, so with a broad reduction in business activity and a slowdown or second month in a row of slowing down of supplier deliveries, those two didn't seem to be very consistent. So I went to look in other areas to see, where might there be some indicators which show what's happening. There were a couple of call outs around container availability, and another one around disruption due to weather for transportation. And so from my perspective, it looked like there was some, and since it was across multiple industries, 3 different industries, it seemed like there was some consistency there. And then when the last check for me was looking at transportation and warehousing, and we're seeing a reduction in business activity there as well. So putting all of that together seemed to be, it seemed to make sense that the comments were in line with what might be happening. They're not conclusive, though. It was just trying to draw different data points together to get a theme around that.
Right. Let's kind of shift to employment a little bit. I mean, the Services PMI data was not the only economic data that came out today that kind of didn't meet expectations. The ADP employment report was also out, and it was lower than what many were projecting. But if you look at our employment index, data and some of the other stuff that go along with it, it was pretty steady, I thought. Just give your impressions of the services labor market and, what some of the challenges are right now.
Yeah. So what I got really mostly, Dan, out of the commentary was that we're seeing people starting to be a little bit cautious as the political season starts to unroll. We're seeing there are many comments around costs not going back, but relaxing in inflation. So to me, it all seems to be weak signals around employment pressure. We're seeing consistent negative. We dropped another point in the employment index. I believe it's the third lowest in several years. So it to me, even though there seems to be strength, unemployment went up a little bit in the last reading. So that versus what we're seeing seems to be consistent from my perspective.
Yeah. And then the inventories index, that one took a pretty big dive, and respondents, said that their companies, there were a couple of comments in there from respondents that their companies were actively trying to reduce, their own stocks, trying to really kind of, for the services, we kind of have 2 indexes that measure inventories. We also have inventory sentiment. That increased and expanded pretty strongly, and you would think, those were kind of contradictory, but demand, the sentiment index, that's also correlated to demand. And obviously, as we've talked about, those indexes this month were not great. Just talk about, elaborate on the inventories situation a little bit. And was, that inventory sentiment index reading, anything, was it pretty much based on demand? The lack of demand was what brought that index up?
Yeah, I think you hit a really important factor there. Mm-hmm. When you see a reduction in demand or business activity, place where you look to look first is what kind of inventory do I have to support mm-hmm. that demand, and is it the right level? Some of the other anecdotally, what we had are comments from the panel that they were putting, as you said, inventory reduction programs in place. And any time you get a new target that says we need to reduce inventory, your natural perspective on that from a sentiment standpoint is industries are inventories are too high. And I think that's the consistency that we saw in the two indexes, is that we have people doing reductions in inventory. From the commentary we see in the business strength, both from a new order standpoint and from a business activity standpoint, that dropping, and the sentiment as we're too high in terms of inventory. So that to me seems to tie together very well.
Yeah, just a kind of a philosophical question in general. I think this is something that I talked about with Tim a little bit the other day, and I've mentioned it to other people. Inventory management, even in the best of times, that's got to be one of the most challenging supply chain disciplines. I don't know, if I could do it, kind of walk that tightrope between making sure that you have enough supply on hand so you don't stock out, versus, obviously it costs money to hold on to inventory, and, you don't want to, make that expense too much of a burden. And, as we all know, it especially was exacerbated as a challenge during the pandemic. How, just, from your experience, just how challenging is that in general? Maybe especially it can be applied to a time like this where, you have kind of sagging demand, and you really, it's not as easy to gauge, what you need on hand.
Yeah, yeah, exactly right. You also have a situation where there is always a tendency when you have strong demand to say, okay, costs are going up, inflation is high, I should capture some of that so that I can have a reduced cost to serve than I would if I waited till later to buy. Well, in this case, costs are starting to moderate. They're still going up, but not going up as fast, which causes you to ask the other question of, gosh, maybe I have too much inventory. Maybe the cost of carrying that, with interest rates being as high as they are, would tend, I got to get back in line and reduce my commitment to inventory. So it's certainly with as we see in the data here, and as we're hearing externally, there are so many things that are in motion that it's a difficult time, because that's you never want to be carrying inventory that you don't have to have, unless you're looking in the future at some either a lack of supply, as we had with the semiconductor spec a few years ago, and which, when you're construction and you're putting in appliances and those types of things, you don't have semiconductors, you don't have appliances. So you want to buy ahead, and then when you see demand soften, then it's just the opposite. Now I've got a carrying cost associated with the interest rates, which is hard to carry, especially when you're starting to see some stability in the higher costs of labor and others across the board.
Yeah. Well, you mentioned some, cost issues. Well, let's move into that. The prices index in June, the reading was 56.3%. That is strong, increasing or expansion territory. But I would think in comparison to some of the readings that we had in the past, some approaching 70% or even 80% at times, that's kind of a welcome reading. And there are indicators suggesting inflation is waning. But you also mentioned in some of the comments, and there were multiple comments from respondents that for some commodities, prices are still very onerous. Just discuss that dynamic.
Yeah, in the index, showing are we seeing prices increase, and how much are we seeing them increase? Mm-hmm. The comments tend to say, in many cases said, we're seeing consistently high prices. We're not seeing that significant inflation or growth that we were seeing last year. And several of the comments were things are flat. We're hitting our business targets. So I believe, since this number, you're just looking over here, it was lower. Well, it was lower in March, and it was lower in June of 23. But other than that, it's a very low number, mm-hmm. Historically speaking, over the last, since the pandemic. Yeah. So I think that is good news. That's good news in terms of less respondents saying they're seeing increase year-over-year pricing, beyond what the current platform that's been set with contract negotiations.
Yeah. Yeah. Speaking of, we mentioned a couple of other indicators. That was something that Tim Fiore, your manufacturing chair counterpart, talked about on Monday. He's about the manufacturing prices index, and he's seeing that concur, with other data, including the federal index numbers that were released on Friday. I mean, are you seeing some of that same thing as you compare the services prices index data with what else is out there?
Dan, the one that I see the consistency on is the labor. Mm-hmm. Labor, when we're seeing a little bit of weakness in labor, and then we're seeing the unemployment rate tick up a little bit, even though hiring is still difficult, finding the right people for the right spots. So that one for me is the one that's more consistent. For me, the overall index for services, you had talked about business activity before. We had kind of a blip, in May. But when you look in April and June. But if you were to, kind of like the old joke, I've got a head in the freezer and my feet in the fire. Overall, I'm feeling pretty good. Watching those things bounce around, to me, it's, a couple of more months, seeing where does this settle out is kind of where I'm thinking at the moment we should have our heads, because it's very the scale of the shift month over month over the last 4 months has been curious. I actually hadn't seen that in any of the data looking back, where we were actually getting into negative territory. Yeah. Contraction. I saw it back when we were in the 60s. I saw that 60% to 67% kind of range bouncing around, but not down at this level. So love to see how that shakes out overall.
Yeah. You were asked about, in the conference call, interest rates. And, obviously that is, something that, as your predecessor, Tony Nieves, often pointed out, because that's what the Business Survey Committee respondents were telling us, that was something that, they were indicating was necessary to have that sort of clarity on that. And as Tim Fiore pointed out on Monday, the last couple of months, the Manufacturing Business Survey Committee members have really started to be more or overt about that sentiment. You had said in the conference call that didn't get as many comments on the necessity for interest rates from Business Services Business Survey Committee members. It doesn't mean it wasn't there. But yeah, just talk about, that dynamic, as I guess the economic and the business world is waiting on the Fed.
Okay. Yeah. So maybe it's just getting comfortable with the kind of the new normal. But as you said, we didn't see as much commentary this month on interest rates. We saw a lot of commentary on costs are high and they're staying high. They're not dropping. But we didn't see many comments on interest rates. We saw one. We saw a few comments on political uncertainty and holding back. in terms of investments and such, with the political uncertainty. Not anybody taking a position of blue versus red, just looking at that. One of the things, though, that I wonder, that I'll be looking at here over the next couple of months too, is in the other services area, which is predominantly repair and maintenance. And I'm curious, Dan, whether that's an indicator of people getting that just the interest rates are going to be high for a while, and so they need to focus on repair and maintenance rather than replacement, due to the higher cost plus the higher interest rates that would go into financing of equipment. We also saw transportation drop, and we saw some issues related to equipment, fire engines, things like that, vehicles, availability. So all in all, I think we're seeing the impact of the higher interest rates. I'm hoping that some of the moderation in the commentary on costs is consistent with what's happening out there in the market, and that the Fed will see that as a moderating influence. I do, although, I'd love to see interest rates come down. I always like to see interest rates come down. It does seem reasonable that, based on what we've seen with the up and down on the index, that we wait a little bit to see really what's happening, rather than taking action quickly. So it seems like the Fed has got a good approach there.
Yeah. One of the, questions that I like to ask, and it's one of the things ISM, tries to convey about the report on business. And since this is your first go around as the services chair, I'll give you an opportunity to talk about it a little bit, is just the practical uses of, that businesses can get out of the report on business data. So, hey, if I'm a CEO or I'm in the C-suite or an executive, what takeaways can I take from the services data, particularly this month?
Boy, so looking back at the index overall, the May 24 number was 53.8. What we saw for this year, starting in January, we went from 53.4 to 52.6 to 51.4 to 49.4 to 48.8. If you don't have that May blip. What I would probably be taking out of this is that there's some softness, and it looks like it's a trend rather than an event. Again, because of the shift from down to up to down over the last 3 months, I want to keep my eye on it. But that's what I'd be thinking in terms of how do I moderate and maybe how do I promote and drive business. It looks like it's going to be a competitive environment based on a reduced business activity and reduced expansion. Still overall from the beginning of the year, expansion. So it's not time for a fire sale, but certainly I think a time where competition is probably going to heat up.
Yeah. Well, hey, Steve, those are all the questions that I had. I really appreciate you, taking time to talk to me today. I mean, is there anything that I haven't asked or anything that we haven't talked about, from the report this month that you think might be important to highlight?
As always, Dan, I think you did a good job on bringing up the most important shifts and changes in the index, and pointed out the ones that we should be thinking about. I appreciate the opportunity to answer the questions and address those.
Yeah, well, I know it's important to know. I know you'll be keeping a close eye on the activity over the next month. That old saying, 1 month is not a trend, but 2 out of 3 months, you start thinking about that. Yeah. So we will keep a close eye on the data as we prepare for the July report, and we'll see you back here in a month. And if thanks for joining us today. For more information, feel free to go to ismworld.org, where in a little bit you can read our roundup article that details a lot of what Steve and I have discussed here, as well as how the markets are taking the data. And if you'd like to be a part of the ISM manufacturing, services, or hospital business survey committees that help compile the data for the report on business, you can also visit ismworld.org and add the /join the panel for more information. And I see there was a comment there. If you're on LinkedIn, you can click on the link there in the chat and do it that way. So we'll see you back here in a month's time when we break down the July ISM report on business. For Steve Miller and some good folks who helped us behind the scenes, Christina Cahill and Jennifer Stevens, I'm Dan Zeiger. Hope you have a wonderful 4th of July, and especially for those of you that get an extra long weekend out of it. And we'll see you back here next time.